Hey there, future millionaires. Welcome to our channel, where we explore the latest and greatest ideas for managing your money and building wealth. I'm your host, Rehan, and today we're counting down the top 10 ideas for personal finance and investing. From budgeting to diversification, we've got you covered. So, let's dive in. First up on our list of personal finance tips is budgeting. And there's no better place to start than with the 50-30-20 rule. This method helps you allocate your after-tax income into three main categories: needs, wants, and savings. Allocate 50% of your income towards necessities like rent, groceries, and utilities. 30% goes to wants, dining out, entertainment, and shopping. Finally, 20% for savings and debt repayment. Remember, the 50-30-20 rule is a guideline, not a rigid rule. Let's face it, traditional savings accounts haven't exactly been known for their generous interest rates. That's where high-yield savings accounts come in, offering a breath of fresh air for your hard-earned money. High-yield savings accounts offer significantly higher interest rates than their traditional counterparts. While traditional savings accounts might offer a paltry 0.01% interest, high-yield savings accounts can reward you with interest rates up to 2% or more. These accounts are typically offered by online banks or credit unions with lower overhead costs. These cost savings are then passed on to customers in the form of higher interest rates. High-yield savings accounts offer the same level of security as traditional savings accounts, as they are FDIC insured up to $250,000 per depositor per insured bank. Opening a high-yield savings account is a simple and straightforward process. So, why settle for meager returns when you can watch your money grow faster with a high-yield savings account? Now, let's dive into the world of investing, where index funds reign supreme as a cornerstone of a well-rounded portfolio. Index funds offer a simple yet powerful way to invest in the stock market without the stress of picking individual stocks. Imagine trying to predict which stocks will outperform the market. Index funds eliminate this guesswork by passively tracking a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. Instead of trying to beat the market, index funds aim to match its performance. They achieve this by holding a basket of stocks that mirror the composition of the underlying index. One of the most significant advantages of index funds is their low costs. Unlike actively managed mutual funds that charge high fees, index funds have minimal expense ratios. Moreover, index funds offer instant diversification, spreading your investments across hundreds or even thousands of stocks. Debt can feel like a heavy weight on your shoulders, but fear not, for the snowball method is here to help you break free. This popular debt repayment strategy focuses on building momentum by tackling your debts strategically. The snowball method starts by listing all your debts from smallest to largest, regardless of their interest rates. Then, you focus on making minimum payments on all debts except the smallest one. You throw every extra dollar you can at the smallest debt until it's completely paid off. Once the smallest debt is conquered, you move on to the next smallest, rolling over the amount you were paying on the previous debt into the next one. This creates a snowball effect as you gain momentum and see tangible progress. While the snowball method might not be the most mathematically efficient, its psychological impact is undeniable. Retirement might seem like a lifetime away, but it's never too early to start planning for your financial future. That's where 401k and IRA accounts come in, offering tax-advantaged ways to save for your golden years. Let's start with the 401k, a retirement savings plan sponsored by your employer. With a 401k, you contribute a portion of your pre-tax income to the plan, reducing your taxable income. Many employers offer 401k matching contributions, where they match a percentage of your contributions up to a certain limit. Next, we have individual retirement accounts, or IRAs. These are retirement accounts that you set up yourself, offering tax advantages and a wide range of investment options. There are two main types of IRAs: traditional IRAs, and Roth IRAs. Consult with a financial advisor to determine which option aligns best with your long-term retirement plan. You've probably heard the saying, "Don't put all your eggs in one basket." Well, this age-old wisdom rings especially true in the world of investing. Diversification is the key to mitigating risk and safeguarding your portfolio from market volatility. Imagine investing all your money in a single stock, only to see its price plummet due to unforeseen circumstances. Diversification helps you avoid such scenarios by spreading your investments across various asset classes, sectors, and geographies. Think of your portfolio as a pie chart. Instead of having one massive slice representing a single investment, diversification allows you to divide the pie into smaller slices. By diversifying across asset classes like stocks, bonds, and real estate, you're essentially hedging your bets. This ensures that your portfolio isn't overly reliant on the performance of a single sector. In today's credit-driven world, your credit score is more than just a number. It's a passport to financial freedom. A good credit score can unlock lower interest rates on loans, better credit card rewards, and even influence your ability to rent an apartment or secure insurance. So, how do you build and maintain a healthy credit score? It all starts with understanding the factors that influence your score. Payment history is paramount, accounting for a significant portion of your credit score. Make those payments on time, every time, and watch your score soar. Next, we have credit utilization, which refers to the amount of credit you're using compared to your total available credit. Keep your credit utilization low, ideally below 30%. The length of your credit history also plays a role. Avoid closing old credit accounts even if you're not using them, as they contribute to the length of your credit history. Real estate has long been considered a tangible and potentially lucrative investment avenue, offering both the possibility of passive income and long-term appreciation. Whether you're a seasoned investor or just starting out, real estate investing can play a valuable role in your portfolio. One popular approach to real estate investing is through rental properties. By owning and renting out properties, you can generate a steady stream of passive income while potentially benefiting from property value appreciation over time. However, being a landlord comes with its own set of responsibilities, including property maintenance, tenant management, and potential vacancies. If you're not keen on the hands-on aspect of rental properties, real estate investment trusts, or REITs, offer an alternative. REITs are companies that own, operate, or finance income-generating real estate. By investing in REITs, you can gain exposure to the real estate market without the hassles of direct property ownership. Taxes. We all have to pay them, but that doesn't mean we can't optimize our finances to minimize our tax liability. Tax optimization is not about evading taxes. It's about taking advantage of legal deductions, credits, and loopholes to reduce your tax burden. One of the most effective ways to optimize your taxes is by maximizing your deductions. Deductions reduce your taxable income, potentially lowering your tax bill. Common deductions include those for mortgage interest, state and local taxes, and charitable contributions. Tax credits, unlike deductions, directly reduce your tax liability dollar for dollar. Tax-advantaged accounts such as 401ks and IRAs offer tax benefits for retirement savings. Consider consulting with a qualified tax professional to ensure you're taking advantage of all applicable deductions, credits, and tax optimization strategies. In the ever-evolving world of personal finance, knowledge is power. Embracing financial education is an ongoing journey that empowers you to make informed decisions about your money and build a secure financial future. Fortunately, we live in an era where financial knowledge is more accessible than ever before. From books and blogs to podcasts and online courses, there's a wealth of resources available at your fingertips. Start by identifying your areas of interest or weakness. Are you looking to improve your budgeting skills, explore investment options, or gain a deeper understanding of retirement planning. Don't be afraid to seek guidance from reputable sources. Remember, financial education is not a one-time event, it's a lifelong pursuit. There you have it, folks. The top 10 ideas for personal finance and investing. Remember, managing your money is a lifelong journey and knowledge is power. Thanks for watching, and we'll see you in the next video.